To invest. Is the purpose of investing to get rich? Now, when you hear the phrase that your cash becomes less valuable, it usually prompts this discussion about investing. The Federal Reserve has an inflation target of 2%, which they meet by increasing or decreasing interest rates. And they do this for maximum economic stability as well as ensuring job employment. If you were to put $1,000 into a savings account with Bank of America, the interest rate on a standard savings account as of today is about 0.01%. The argument for investing is that it allows you to protect the value of your money as the cost of living rises. People who are very wealthy invest their money and use the markets as a way to preserve and grow their wealth. Can you get rich from investing with a job? As far as I know, the only way that an individual can get rich from investing as a primary activity is if they have an investment company and they leverage other people's money to invest and they take a management fee or take a cut. That's basically what Warren Buffett did. The world's most famous and richest investor was also an entrepreneur first. So in this video, I'm gonna go from the order of lowest risk to highest risk, but remember that with risk also comes return. So lower risk, lower return, higher risk, potentially higher return. The first option for investing $1,000 is through a certificate of deposit. When you deposit cash into a certificate of deposit, you're given a fixed interest over a set period of time. And at any point in time, you can go onto a bank's website, like Bank of America, and check what the current offers and rates are. These rates that the banks offer are influenced by the overall interest rates in the country and the interest rates that have been set by the Federal Reserve. The reason why the interest rate on a certificate of deposit is higher than a savings account is because of this agreement that you are going to leave your money with the bank for a set amount of time. This offers the bank liquidity to conduct its operations. So they basically use that money to loan out to other people in the form of mortgages and loans to collect interest, and that's how a bank makes its money. A certificate of deposit is very low risk. It is so low risk that it is borderline barely even considered investing because it's basically just an interest account that has withdrawal restrictions. The biggest consideration is that you're going to be locking up your money or your capital for a fixed amount of time. One thing to be cautious about is the timing of the agreement, because with certificate of deposits, the longer you lock up your money for, the higher the interests are usually offered. But that also depends on the interest rates in the economy as well. If you expect interest rates to go up, then it might not be a good idea to lock up your money today for a very long period of time because you're going to be fixed with that interest rate. The second option is a mutual fund. A mutual fund is an actively managed fund that provides investors a wide mix of assets. The reason why they're actively managed is because there's a group of professional fund managers whose full-time job is to manage the fund, make decisions for the fund, and stay on top of market opportunities and basically make decisions that are in line with the objective of the fund. That's why it is active management. How you as an investor will make money from a mutual fund is that the fund will pay distributions to you as an investor based on what the fund invests in. So if a fund owned real estate and earned interest income on that real estate, then the fund will distribute that interest income to its shareholders based on the percentage of ownership. If a fund owns stocks and those stocks distributed dividend income to the fund, then the dividend income gets distributed down to the shareholders of the fund. When you invest in a mutual fund, you are investing in the basket of assets that the mutual fund invests in. For example, there could be a precious metals mutual fund that invests in precious metals. There could be a real estate mutual fund that invests in real estate. Be a US equity mutual fund that only invests in US stocks. Mutual funds update their price once a day at the end of the day using something called the fund's NAV, or net asset value. Net asset value is the fund's total assets minus its total liabilities. And the price of the mutual fund to you is basically the fund's net worth plus any management expense fees. This is fundamentally different than stocks because stocks trade on a secondary market and the price of stocks depend on supply and demand, whereas the price of a mutual fund is determined by what the fund owns and what the fund owes. So by nature, mutual funds tend to not have as huge of a price appreciation as stocks do, because stocks are priced based on supply and demand, aka investor expectations. Now, in order to pay the fund managers and employees and other expenses associated with actively managing the fund has to charge its investors a management expense ratio, MER. Mutual funds do not have trading commissions, so you don't have to pay per trade. So while in theory, a mutual fund that has a group of people that are actively trying to beat the market with their expertise and their knowledge, the fund also tends to have much higher expenses that get passed off to the investors as a result of that active management. Index funds are similar to mutual funds in how they're priced and sold, but the difference is that the investment thesis for an index fund is that they just track an index. Indexes include S&P 500, Dow Jones Industrial Average, the NASDAQ. These are indexes. You can't invest in them directly. The closest thing that you can do to get the same returns of the index is to invest in the index fund. So you can invest in the S&P 500 index. There are different types of indexes, but at the end of the day, they're all just a categorization of companies. S&P 500, which is a very common everyday term, is the most well-known index. It represents the 500 largest US companies. Indexes themselves are managed by committees, and these committees determine the criteria that companies must meet. So for the S&P 500, there is a committee that determines what constitutes or what puts a company in that category, in terms of size, liquidity, and these companies on the S&P 500 are actually changing all the time. And if a company no longer meets S&P 500 criteria, they end up getting kicked out. So that's why the index fund itself doesn't really require active management, because there are no investment decisions to be made. The criteria of what constitutes as an index has already been defined. So investing in an index fund allows you as an investor to own a portfolio that replicates that index. The next option is an ETF or an exchange traded fund. Now, there are some similarities between mutual funds, index funds, and ETFs. The biggest similarity is that with an ETF, you can also buy a basket of companies or a basket of assets. The biggest difference between an ETF and mutual funds is how they are bought and sold, which is fundamentally different. An ETF can be traded throughout the day. ETFs trade on exchanges and they will have a bid-ask spread. Now, even though this is the case, ETFs are still more closely related to mutual funds than they are to stocks, because an ETF is still a fund. They still have a NAV, and their market price is actually always very close to the net asset value of the fund because of this process called creation and redemptions. It's an arbitrage mechanism where there's basically third parties that regulate the supply of shares to keep the trading price of the ETF as closely to the NAV as possible. There are different types of ETFs. The most common is passively managed ETFs that trade indexes, but there are also bond ETFs. There's industry or sector specific ETFs, commodity ETFs, Bitcoin ETFs. ETFs will have trading fees, so it will cost you to buy and sell the ETF, but they tend to have a lower trading fee than stocks do. Option number 5 is a REIT, or a real estate investment trust. Not as common as ETFs, mutual funds, and stocks, but still worth a discussion. A real estate investment trust is exactly what it sounds like. It's investing in a real estate company that owns real estate. So a REIT is a company, they own real estate and they earn money from rental income, capital gains. So if you buy units of a REIT, you're investing in a basket of real estate. Every REIT may own different property types. They can own single family homes, they can own apartment buildings, they can own commercial buildings, shopping mall. Again, it depends on the investment thesis of the REIT and the company. And some REITs also invest in real estate debt as well. So they will buy mortgages, commercial loans, mortgage-backed securities. What a REIT will allow you to do is invest in real estate, such as commercial real estate, without having to have hundreds of millions of dollars to do it yourself. Option number 6, dividend stocks. Now we're getting into stocks. When you buy a stock, you're buying shares of a company. Now there are different types of stocks, but generally 2 categories overall. The first is a dividend stock, which means that you are buying the stock with an expectation of income. The second is a growth stock, which means that you are buying the stock with the expectation of an increase in the stock price. Dividend stocks will pay a cash flow to you, sometimes monthly, but usually quarterly. Usually these are more mature and stable cash flow positive companies because a company needs to have cash flow to be able to distribute dividends to its shareholders. Rather than reinvest that cash back into the company, the board of directors opts to distribute that cash out to its shareholders to incentivize them to buy the stock. Dividend stocks typically have a return of anywhere between 2% to 8%. It really depends on what the board of the company decides. These returns can change every quarter. For example, if you invested the entire $1,000 into a dividend stock that paid 5% annually, that would be $50 a year. Now I know $50 as a return might not sound a lot, but remember what I said earlier in the video. If you invested $1,000 into a savings account that would pay 10 cents, getting $50 on your $1,000 in comparison is a 500-time difference. And with dividend stocks, you can also expect a small appreciation in the stock price over time. Next is growth stocks. So growth stocks are stocks that investors expect to earn an above average return because of that business's strategy and product offerings, which is determined by the price of the stock relative to its earnings, otherwise known as the PE ratio. Nvidia's PE ratio as of today is 75, meaning that Nvidia is trading 75 times more in dollars than what they are earning per share. In comparison, looking at another tech stock, Apple's PE ratio is 34. And just as a case study, the reason why Nvidia is trading at such a high PE ratio is because it's one of the hottest stocks right now because their business strategy is centered around artificial intelligence. So if you invested $1,000 in Nvidia in 2022, that would literally be $10,000 today. Ever since ChatGPT came out, Nvidia stock has gone up 10 times because ChatGPT uses Nvidia's GPUs. One thing I want to talk about up to this point is trading fees, and this impacts stocks and ETFs mostly. If you open a self-direct investment account, there are typically trading fees associated with every transaction. So if you were to buy a dividend stock and it did give you a 5% return annually, that's $50 a year. But depending on the brokerage that you sign up for, it could cost you up to $10 to make that trade. So keep that in mind that you do pick a brokerage that doesn't charge very high in fees. And if you do go with someone that does charge a lot in fees, like $10 a trade, that you're not making trades on a regular basis because that's going to eat away at a lot of your profits. You might be thinking about diversification. With $1,000, you might want to buy 10 different stocks. So you're thinking, is that a good idea? Now, to a certain extent, it's probably not worth it because if you want diversification and you have $1,000 to invest, then I would actually recommend going for an ETF or a mutual fund or an index fund because the diversification will basically be built in and the fees will be lower. If you were to self-direct trade stocks with $1,000 and you bought 5 different stocks and each buy costs you $10 and each sell costs you $10, you could potentially be spending more money in trading fees than what you make on the actual stock. And if that's a strategy that you want to go for, make sure you go with a broker that has low trading fees. But the best way to diversify if you're starting out with a small amount of capital is to purchase an investment that already has diversification built in. Another consideration is foreign exchange. Now, if you buy stocks in a different country or in a different currency, you'll be subject to foreign exchange, assuming that you have to convert your native currency into the currency of that country. If you're watching this and you're Canadian, you're Australian, you're from the UK, and you want to buy US stocks, make sure you also think about the exchange rate as well because you are inherently investing in the country's exchange rate too. The analogy I'd give is it's kind of the same as traveling. For example, right now as a Canadian, you probably wouldn't want to travel to the US because the US dollar is extremely strong. And let's say that as a Canadian, you have Canadian dollars, that's what you have in your bank account, and you buy a US stock like Apple. If Apple goes up by 20%, but the US dollar ends up weakening by 5 points, then your overall gain actually gets pruned by 5 points just because of the foreign exchange. assuming that you do convert that US dollars back into Canadian dollars at some point. So that goes no matter where you live in the world, so long as you are buying another country's stock. So if you're in the US and you're buying Canadian stocks, you also want to think about the foreign exchange impact as well. Option number 8 is cryptocurrency. Now, there are a lot of different types of cryptocurrency, but by far the most popular one that everyone has heard of is Bitcoin. Bitcoin is a virtual currency, unlike traditional fiat currencies, is not backed by a physical commodity like gold or silver, and it's not backed by the government or the Federal Reserve. Bitcoin is backed by a decentralized network and technology that has never been compromised before, otherwise known as blockchain technology. Blockchain technology is a public ledger of transactions. It can be applied to any field of business, really, but the most popular and the mainstream application is with Bitcoin and cryptocurrencies. But it is an important distinction to understand that blockchain is not crypto. Blockchain is a technology at which crypto sits on top of. If you're interested in investing in Bitcoin, I highly suggest understanding blockchain technology and how it works first and foremost, because it's your knowledge and your confidence in the technology that will provide you with the assurance of your investment. But yes, the value of the coin itself is driven by supply and demand, which is highly speculative in nature and is considered high risk. And how you mitigate that risk, in my opinion, is just an understanding and confidence in the technology itself. Now, option number 9, the bonus option. I saved the best for last. The option is to invest back into yourself. If you truly want long-term financial freedom and financial success, it's going to be far beyond saving money from a job and investing in ETFs and stocks. If you want to live a great life, a financial life, then what you really need to learn is how to create a lot of net income, how to create multiple streams of income for yourself. You need to invest in yourself so that you are basically good enough to achieve anything that you want in your life. And how you can get started if you have $1,000 is to start by reading books. Some of the most popular personal finance books, business books, and self-development books, they only cost 20 or 30 bucks. And a lot of them are written in autobiography format from people who are already successful. When you buy a book, you get a whole lifetime of that person's knowledge. You get to learn from their mistakes and fundamentally kind of like rewire your brain for success. And you will, once you read more and more of the books, realize that all successful and very competent people in life, they all think a certain way. Assuming that you do take action on what you learn, I think that books generally provide the best ROI out of anything else that you could possibly invest in. Whether it's investing your first $1,000 or you are a very sophisticated investor yourself, let me know down in the comments below, and I'll see you guys in the next video. Until next time.